Hello from the Dukascopy TV studio in Geneva. We are talking about the oil price. Will $60 be the new normal? I'm joined by Lorne Baring from B Capital. Welcome to the studio.
Hi, Daniel.
So, after the recent OPEC meeting, there won't be any changes in the production of crude oil. So what will this mean for the oil price?
Well, I think that the last 6 months has been a very interesting period for investors to watch the oil price dropping from the normal of around $100 to somewhere around $50. The reasons for that are from both supply and demand side. There's been very soft aggregate demand, and we've seen OPEC maximizing output, many other countries also producing as much as they can. And I think there's been also an underestimate of the shale oil, shale gas production capabilities in the US. OPEC wants to keep market share, and as a result of the production in the US, its new client and its biggest client will probably be Asia. The result of, of that change is that by lowering the oil price deliberately, OPEC is able to grab more market share, and everybody's pumping more oil. The result is that we are in a new range, and I expect that we will see oil at this new range somewhere between $60 and $80 for some time. Now, the situation is improving globally. There is global growth, so it's quite possible that from here the oil price might rise somewhat further. We've seen it come off the bottom at just above 50 to the current level around 66. I think it could go higher in the short term, but probably we are now in a lower range, and that will stay for the medium term.
Do you see any additional factors impacting the oil price in the near future, also political reasons?
Well, I think the market always has to be prepared for a supply shock. So the Middle East often has some supply shock potential, and that could still happen. But I do think in aggregate there's going to continue to be lots of supply, relatively soft demand, and that's going to keep the oil price in this lower band.
So what will this mean now for the European and American economy?
Well, I think Europe benefits as a net importer of energy, so this is supportive. It's a tailwind for the European economy. It's also good news for the US to have, in general, lower energy prices. In aggregate for the whole world, on average, if energy prices are lower, that's going to help global growth.
And so there's also the connection, of course, oil price and the dollar. So do you see this benefiting the dollar and its appreciation?
Well, I think this has been a factor on top of the supply and demand story, that all commodities are priced in dollars, and the dollar has been very strong in the last 6 months. The result is that that has affected all commodity prices, as the price of as dollar strength is inversely affecting commodity prices. Gold is another one. You've seen it across the whole commodity spectrum.
So how should investors price this in?
Well, I think that our advice to investors is to remain long dollar assets and long the dollar generally. If investors are looking at the different asset classes, we still think that commodities across the board will remain relatively under pressure, and with a strong dollar, it drives investors to other asset classes. So at the moment, I would say be very cautious about commodities.
Thank you very much, Lorne Baring from B Capital, for being here today.
Thank you for having me.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.